Have you ever noticed how every week someone is talking about a new breakout stock? Open YouTube, scroll through Twitter or Telegram, and you'll see people saying, "This stock has broken out. It's going to the moon," and honestly, it's easy to get excited. You see a stock crossing resistance, the chart looks amazing, everyone seems bullish, and you start thinking, maybe I should buy it before it goes even higher. But here's something most people don't realize. Not every breakout turns into a winning investment. In fact, many breakouts fail within just a few days or weeks. The stock moves above resistance, attracts a lot of buyers, and then suddenly falls back below that same level. That's called a false breakout. And unfortunately, many retail investors end up buying exactly when the smart money is selling. So today, I want to show you something much more important than simply finding breakout stocks. I want to show you how to separate high-quality breakouts from the ones that are likely to fail. We'll also look at 3 well-known large-cap companies that are showing interesting breakout patterns. But remember, this video isn't about telling you what to buy. It's about teaching you how to think before you invest. So let's begin. Whenever I see a breakout on the chart, I don't immediately buy the stock. Instead, I ask myself 5 simple questions. These 5 questions have saved me from making a lot of bad decisions. The first question is, has the stock been consolidating for a long time? Think of consolidation like stretching a rubber band. The longer you stretch it, the stronger the movement can be once it's released. A stock that spends several months moving sideways usually builds a stronger base than a stock that suddenly jumps after only a few days. That's why long consolidations are generally more reliable. The second question is, did the breakout happen with strong volume? Volume tells you whether big investors are actually participating. If the price moves higher but volume remains weak, that's a warning sign. But when price and volume both increase together, it usually means institutions are entering the stock. And that's something you always want to see. The third question is, how strong are the company's financials? A beautiful chart cannot hide a weak business forever. Is revenue growing? Are profits improving? Is the company becoming stronger every year? These are questions every investor should ask. The fourth question is the company generating healthy cash flow? This is something many beginners ignore. A company can report profits on paper, but cash flow tells you whether it's actually bringing money into the business. Strong cash flow usually means the company has the ability to invest, expand, reduce debt, and reward shareholders. And finally, is there a real reason for the business to grow? Maybe it's entering a fast-growing industry. Maybe demand for its products is increasing. Maybe government policies support its business. Whatever the reason is, there should be a genuine growth story behind the company. When both the chart and the business tell the same story, that's when a breakout becomes much more interesting. Now let's look at our first company. The first stock is Sun Pharmaceutical Industries. If you look at the chart, you'll notice something interesting. Back in late 2024, the stock reached a new high. Instead of continuing to rise, it spent months moving sideways. At first glance, that may look boring. But experienced investors often like this type of price action. Why? Because the stock is taking time to digest its previous gains instead of crashing. Now the price is once again trading close to those earlier highs. From a technical perspective, this is the kind of setup many traders watch carefully. But charts alone aren't enough. Let's look at the business. Sun Pharma is India's largest pharmaceutical company and has built a strong presence in specialty medicines. These products usually offer better profit margins than regular generic medicines. Over the last few years, the company has continued improving its revenue and operating profits. Its cash flow has remained healthy, and that's an important sign because it means the business is generating real cash, not just accounting profits. When you combine a strong business with a technically strong chart, the breakout becomes much more meaningful. Now let's move to the second company. Tata Power. When most people hear Tata Power, they immediately think about renewable energy. And yes, renewable energy is a major part of its business. But that's only one piece of the picture. Tata Power is involved in electricity generation, power distribution, solar energy, transmission infrastructure, rooftop solar projects, and EV charging stations. In other words, it's building an entire energy ecosystem. As India's economy grows, electricity demand is expected to increase across industries, households, and electric vehicles. If that trend continues, companies like Tata Power could benefit over the long term. From a technical point of view, the stock has also spent time consolidating after previous gains. Instead of chasing the stock at any price, smart investors wait for confirmation. If the breakout happens with strong volume while the company's earnings continue improving, it becomes a much stronger investment case. That's exactly why combining technical and fundamental analysis is so important. Now let's talk about the third company. Bharat Electronics Limited or simply BEL. BEL is one of India's leading defense electronics companies. The company supplies advanced electronic systems and equipment for India's defense sector. When you look at the chart, you'll notice another familiar pattern. The stock has been building a strong base after a previous rally. Many traders would call this a healthy consolidation. But let's go beyond the chart. One of BEL's biggest strengths is its massive order book. A large order book means future business is already lined up. That gives investors better visibility into future revenue. The company also has healthy profitability, a strong balance sheet, and consistent financial performance. On top of that, India's focus on strengthening domestic defense manufacturing creates long-term opportunities for companies like BEL. Once again, the technical picture and the business fundamentals seem to support each other. And that's exactly what we're looking for. So what's the biggest lesson from today's video? It's actually very simple. A breakout on a chart is only half the story. The other half is the business itself. Anyone can draw trend lines. Anyone can identify resistance. But not everyone takes the time to understand whether the company deserves to trade at higher prices. That's where long-term investing becomes different from short-term speculation. Before buying any breakout stock, always slow down and ask yourself these 5 questions. Has the stock built a strong base? Did it break out with heavy volume? Are the company's financials improving? Is it generating healthy cash flow? And finally, is there a real business reason for future growth? If most of those answers are yes, then you've probably found a much stronger opportunity than simply following hype on social media. Remember, the stock market rewards patience far more than excitement. The biggest winners are usually the investors who did their homework before investing, not after. So don't chase every breakout you see. Study the chart. Understand the business. Read the financials. And let both technical analysis and fundamentals work together. That's how you improve your chances of finding stocks that don't just break out, but continue creating wealth over the long term. If you found this video helpful, make sure to hit the like button and subscribe to the channel because every week we break down stocks, investing strategies, and market opportunities in simple language. Also, I'd love to hear from you. Which breakout stock is currently on your watch list? Let me know in the comments below. Thanks so much for watching, take care, and I'll see you in the next video. Happy investing!